deep dive. Today, we're getting into something really fascinating. Candlestick patterns. Now, I know charts, but this is way more than just lines. Our sources are calling these the actual language of price action.
That's a great way to put it. It really is like learning a language.
Yeah, and it seems like a vital skill if you want to, understand what the market's actually doing.
Absolutely.
So whether you're totally new to trading or maybe you've dabbled a bit, we think this deep dive will give you some really powerful insights.
Definitely. And the great thing is, this visual language, it's pretty universal.
Universal how?
Well, it doesn't really matter what market you're looking at. Forex, crypto, stocks, the patterns show up.
Okay.
Because they tap into something fundamental. The psychology and behavior of buyers and sellers. You're seeing that fight play out.
So it's like a window into the crowd's mindset.
Exactly. And that helps you maybe anticipate what could happen next. It's about understanding the story. So our mission today, really, is to give you a bit of a shortcut to reading that visual story. Make it clearer.
Okay, love it. A shortcut sounds good.
Yeah.
So here's the plan. First, we'll kind of unpack the basics, like what are these things fundamentally?
The building blocks.
Exactly. Then we'll get into specific examples. We'll start simple, single candles.
Yep.
Then move to double, then triple patterns, building up the complexity.
Right. Seeing how the narrative builds.
And we won't leave you hanging. We'll wrap it all up with some really crucial practical tips, how to actually use this stuff.
Yeah, the application is key.
Definitely. Okay, so let's kick things off. The fundamentals. When we see a candlestick, what are we actually looking at beyond just price moving?
That's the perfect starting point. It's easy to just see, a green bar or a red bar and move on.
Right.
But each single candle, in whatever time frame you've chosen, packs in 4 critical bits of info.
Okay, what are they?
You've got the opening price for that period, the closing price, the high point it reached, and the low point. 4 key numbers.
Open, close, high, low.
Got it. And it's not just those numbers, it's the relationship between them. How wide is the range? Where did it close relative to the open? That's what starts telling the story.
Okay. So the shape matters.
Hugely. And then when you put these candles together, the patterns they form, that's what helps us try to predict, or at least anticipate, where the market might be heading.
So each candle is like a word.
Yeah, exactly. And the patterns are like sentences, telling you about the market's mood, its intentions.
I like that analogy, sentences. Okay, so if one candle is a word, let's look at some keywords. Single candle patterns. They seem simple, but our sources say they're powerful tools if you see them in the right place.
They absolutely can be. Context is everything. But yeah, let's look at a few key single candle signals.
Yeah.
First up, maybe the doji.
The doji. Okay, what's that telling us?
Pure indecision. Think of it like a perfect tie in a tug of war. Price might have moved around a lot during that period.
Yeah, up and down.
Yeah, but it opened and closed at basically the exact same price.
Yep.
Neither buyers nor sellers won that round.
So a stalemate. Why is that important?
Because stalemates usually break. It often signals that a significant move could be coming once either the buyers or sellers finally take control. It's a pause, a moment of tension.
Okay. What else? What about the hammer?
The hammer. Classic bullish reversal pattern. You usually find it after a downtrend.
Right.
But what you see is a small body near the top and a long lower shadow, like a tail.
Okay.
That long shadow tells you sellers tried hard to push the price down, but the buyers came roaring back and pushed it right back up near the opening price. It's like the market hammered out a bottom. Shows buyer strengths are turning.
Hammered out a bottom. I like that. Now, you mentioned its counterpart.
Right, the hanging man. Now, visually, it looks exactly like a hammer. Small body, long lower shadow.
Okay. So what's the difference?
Location, location, location. The hanging man appears at the top of an uptrend.
Okay. So same shape, different meaning based on context.
Totally different meaning. Here, that same shape suggests that even though buyers pushed it up initially, sellers managed to pull it back down significantly. It hints at potential selling pressure appearing, or buying exhaustion, near the peak. It's a warning sign in an uptrend.
Interesting how context flips the meaning. What about the shooting star?
Another bearish reversal one. Kind of the opposite of a hammer in shape. Small body at the bottom this time with a long upper shadow.
So like an upside-down hammer.
Sort of, yeah. It specifically shows that buyers tried to push prices much higher during the period, but sellers rejected those higher prices aggressively and drove it back down near the open. Strong rejection of highs.
Okay, rejection. Got it. And one more single pattern, the inverted hammer.
Right. This one's bullish, appears in a downtrend, and looks like, well, an upside-down hammer or a shooting star, but in a downtrend.
Okay, so buyers tried to push up, but sellers push back down. Why is that bullish?
Good question. It shows buyers are testing the waters, trying to push higher, but, and this is crucial, it needs confirmation.
Confirmation, what does that mean?
It means the next candle is really important. You'd want to see a strong green candle follow the inverted hammer to confirm that buyers are actually taking control. Without that follow-through, it's just a failed attempt.
Okay, so confirmation is key for that one. This is like detective work, isn't it? Putting clues together.
Yeah, a bit like that visual detective work.
You mentioned context and confirmation, so moving on. What happens when we start putting two candles together? Double patterns. Do they give us a clearer picture?
Often, yes. The interplay between two consecutive candles can definitely build a stronger narrative. And our sources point out something important here.
What's that?
These double patterns, they work best with support resistance zones or trend lines to confirm the signal.
Okay, can you quickly explain support and resistance and trend lines for anyone who might not know?
Sure. Support is like a price floor where buying interest historically comes in and stops price from falling further. Resistance is the opposite, a price ceiling where selling interest tends to emerge. And trend lines are just lines you draw connecting consecutive lows in an uptrend or consecutive highs in a downtrend to show the general direction.
Got it. So patterns near these levels are more significant.
Much more significant. Okay, so let's look at a big one. The bullish engulfing pattern.
Bullish engulfing. Okay.
This happens in a downtrend. You have a red candle showing selling, followed by a larger green candle whose body completely engulfs or covers the body of the previous red candle.
Engulfs it. Wow.
Yeah, it's a powerful visual. It shows that in that single period, buyers completely overwhelmed the previous period's selling pressure, a very strong potential reversal signal.
Makes sense. And I assume there's a bearish version.
You got it. The bearish engulfing, same idea, but reversed, happens in an uptrend. You get a green candle followed by a larger red candle that completely engulfs the green one's body.
So sellers took complete control.
Exactly. Signals the sellers have stepped in decisively.
Yeah.
And with both engulfing patterns, look at the volume. If the engulfing candle has higher volume, that adds weight to the signal.
Yeah.
Shows conviction.
Volume adds conviction. Dip. What other double patterns are there?
Another pair to know are the tweezer bottom and tweezer top.
Tweezers.
Yeah. Think of tweezers having two matching tips. A tweezer bottom is when two consecutive candles have almost identical lows.
Okay.
It suggests the price tried to go lower twice, hit that same level, and got rejected both times. It reinforces that level as strong support, potential bottom forming.
So a strong floor and the tweezer top.
Opposite scenario. Two consecutive candles with almost identical highs. Price tried to break higher twice, hit the same ceiling, and failed. Reinforces resistance. Potential top.
Okay, this seemed quite intuitive visually.
Yeah.
Matching highs or lows signal rejection.
Precisely. Rejection at a specific price point.
All right, we've covered singles and doubles. Now let's level up again. Triple candlestick patterns. Our sources say these are generally more reliable. Why is that?
Well, it's kind of logical, isn't it? You have more data points, more price action involved. 3 candles give the market more time to confirm a shift in sentiment compared to just 1 or 2.
More data, more confirmation. Makes sense.
But again, context is crucial. The sources emphasize that volume and trend context matter, perhaps even more with these complex patterns. You really want to see them forming at logical places on the chart.
Right. Context and location again. So what are some key triple patterns?
Let's start with the Morningstar. This is a classic bullish reversal pattern.
Morningstar.
Okay, it has 3 parts. First, a long red candle, continuing the downtrend. Then a small-bodied candle, could be a doji, could be something similar that often gaps down slightly. This shows indecision, a weakening of the selling pressure.
The pause, like the doji we discussed.
Exactly. And the crucial third candle is a strong green candle that closes well up into the body of that first red candle.
Ah, so it confirms the buyers are back.
Yes, it signals a significant shift from selling dominance to buying dominance over those 3 periods. Very hopeful sign for bulls after a fall.
And the bearish version.
Sure.
That would be the evening star. Same structure, but reversed and occurs after an uptrend. Starts with a strong green candle, then the small indecision candle, often gapping up, followed by a strong red candle closing well into the first green candle's body. Signals a potential top and reversal downwards.
Morning star for bottoms, evening star for tops. Got it. What else?
Then you have patterns showing continuation or very strong reversals, like the 3 white soldiers.
Sounds bullish.
Very bullish. It's 3 consecutive long green candles. Each one typically opens within the body of the previous one and closes higher, making the new high.
Like stairs stepping up.
Yeah, exactly.
Yeah.
It shows sustained, strong buying pressure over 3 periods. Often marks the start of a new uptrend or a significant reversal up.
And the dark side.
The 3 black crows, same concept, but bearish. 3 consecutive long red candles, each typically opening within the prior candle's body and closing lower, making a new low.
Stairs stepping down.
Precisely. Shows sustained, heavy selling pressure. Often signals the start of a downtrend or confirms one is underway.
Okay, these multi-candle patterns definitely seem to tell a more developed story.
They really do. More confirmation built right in.
All right, this is all fascinating, learning the language. But the big question always is, how do we actually use this? What does this mean for you, the listener, in practice? How do we apply this without falling into traps?
Yeah, that's where the rubber meets the road, isn't it?
Yeah.
Knowing the patterns is one thing, using them effectively is another.
Totally.
So the sources give some really solid guidelines. First one, focus on major time frames.
Major time frames, like what?
Specifically, they mention the 1 hour, 4 hour, and daily charts. Patterns on really short time frames, like 1 minute or 5 minute, can often just be market noise, not reliable signals.
Okay, so higher time frames filter out the noise. Good tip.
Second, and we've touched on this, always use them with support and resistance levels or trend lines.
Context again?
Always context.
Yeah.
A hammer pattern bouncing off a major daily support level. That's much more interesting than one appearing randomly in the middle of a range.
Yeah.
It adds significance.
Right, confirmation from the chart structure itself.
Exactly. Third, don't rely only on candlesticks. Combine them with other technical indicators for extra confirmation.
Other indicators, like what?
Things like the RSI, Relative Strength Index, which measures momentum, or MACD, moving average convergence divergence, another momentum indicator, or even simple moving averages, which show the average price over time.
So if a bullish pattern forms and the RSI shows upward momentum and it's at support, that's a stronger signal.
Much stronger. You're looking for confluence, multiple signals pointing the same way.
Confluence, okay.
Another huge one, patience. Seriously, don't feel like you have to trade every single pattern you think you see.
Avoid overtrading.
Yes. And always, always wait for confirmation before jumping in. For reversal patterns, wait for the next candle to close and confirm the direction change. Don't anticipate.